Welcome to History Explained, where we illuminate the past to better understand our present. I'm your guide to your daily journey through the past to empower the future. Today is Friday, July 4th, 2025. As we do every Friday, we're exploring a significant economic milestone that shaped the development of our modern financial system. Today, we turn our attention to the stock market crash of 1929, one of the most devastating financial collapses in American history. Beginning on October 24, 1929, and culminating on Black Tuesday, October 29, this dramatic market collapse wiped out billions in wealth and triggered the Great Depression, fundamentally altering American economic and political life. What makes the 1929 crash particularly significant is how it demonstrated the interconnectedness of modern financial markets and revealed the dangers of speculative excess. This crisis led to major reforms in financial regulation and changed how governments approach economic policy during times of crisis. So let's explore this pivotal economic catastrophe, examining the speculative bubble that preceded it, the dramatic events of the crash itself, its immediate aftermath, and its lasting impact on American society and global economics. To understand the 1929 crash, we must first examine the speculative boom of the 1920s. Following World War I, America experienced unprecedented economic growth driven by new technologies, consumer goods, and industrial expansion. This prosperity created widespread optimism about the future and fueled massive investment in the stock market. The 1920s saw the emergence of a mass investment culture as ordinary Americans began buying stocks for the first time. Stock ownership, previously limited to wealthy elites, became accessible to middle-class investors through installment plans and margin buying, where investors could purchase stocks with borrowed money. Margin buying proved particularly dangerous because it allowed investors to control large amounts of stock with minimal cash investment. Buyers could purchase $1,000 worth of stock with only $100 down, borrowing the rest from brokers. This leverage amplified both gains and losses, creating enormous risks when stock prices fell. The media and popular culture promoted the idea that stock investment was a sure path to wealth. Newspapers featured success stories of ordinary people becoming rich through stock speculation, while investment advice became a popular topic in magazines and radio programs. New investment vehicles like investment trusts allowed small investors to pool their money and invest in diversified portfolios. However, many of these trusts were poorly managed or engaged in questionable practices, including investing in other investment trusts, creating complex webs of financial interconnection. By 1929, stock prices had reached levels far beyond the underlying value of companies. The price-earnings ratios of many stocks exceeded historical norms by enormous margins, suggesting that speculation rather than fundamental analysis was driving market values. Warning signs appeared throughout 1929, though most investors ignored them. Industrial production had begun to decline, unemployment was rising, and agricultural prices remained depressed. However, stock prices continued climbing, creating a dangerous disconnect between market values and economic reality. The Federal Reserve attempted to cool speculation by raising interest rates, but this action had little immediate effect on stock prices. Instead, it began to strain the broader economy while failing to address the speculative bubble in equity markets. The crash began on Thursday, October 24, 1929, a day that became known as Black Thursday. Heavy selling pressure developed early in the trading session as investors began taking profits and margin calls forced leveraged buyers to sell. The ticker tape fell hours behind as trading volume overwhelmed the system. Panic selling accelerated throughout the day as investors watched their wealth evaporate. By midday, major banks and investment houses organized a rescue effort, with prominent financiers like Richard Whitney purchasing large blocks of stock to stabilize prices. This intervention temporarily halted the decline and restored some confidence. However, the relief proved temporary. Over the weekend, nervous investors decided to sell their holdings when markets reopened. Monday, October 28, saw renewed heavy selling that wiped out the previous week's rescue efforts. The climax came on Tuesday, October 29, 1929, Black Tuesday, when the market experienced its worst single-day decline in history. Trading volume reached unprecedented levels as 16.4 million shares changed hands, a record that would stand for decades. Stock prices collapsed across the board, with some securities losing 50% or more of their value in a single day. The human drama was intense and tragic. Wealthy investors saw fortunes disappear in hours, while margin buyers faced devastating losses that exceeded their initial investments. Stories circulated of ruined speculators jumping from buildings, though these accounts were largely exaggerated. The crash's immediate impact extended far beyond Wall Street. Banks that had invested heavily in stocks or made loans secured by stock collateral faced severe losses. Many banks failed in the weeks following the crash, destroying depositors' savings and contracting credit availability. Consumer confidence collapsed as Americans watched their investments disappear and feared for their jobs. Spending on luxury goods and durable items fell sharply as families postponed major purchases and attempted to rebuild their savings. The crash exposed the fragility of the 1920s prosperity. Much of the decade's growth had been built on consumer debt, stock speculation, and unstable financial structures. When confidence evaporated, these weaknesses quickly became apparent. International effects were severe as American investors withdrew capital from foreign markets and reduced imports. European countries, still recovering from World War I, found themselves facing reduced American investment and trade just as their own economies were beginning to stabilize. The Federal Reserve's response proved inadequate and often counterproductive. Rather than aggressively expanding the money supply to offset deflation, the Fed allowed bank failures to accelerate and credit to contract. This monetary contraction worsened the economic downturn and prolonged the Depression. President Herbert Hoover initially maintained that the economy was fundamentally sound and that recovery would occur naturally. His administration's limited intervention failed to address the crisis's severity, contributing to public disillusionment with Republican economic policies. The crash revealed serious weaknesses in financial regulation and market structure. Securities markets lacked adequate oversight, margin requirements were minimal, and conflicts of interest were common. Banks engaged in speculative activities using depositors' funds, creating systemic risks throughout the financial system. The crisis led to fundamental changes in American economic policy and financial regulation. The Securities Act of 1933 and Securities Exchange Act of 1934 created the Securities and Exchange Commission and established federal oversight of securities markets. These laws required disclosure of financial information and regulated trading practices. Banking reforms included the Glass-Steagall Act, which separated commercial and investment banking, and the creation of federal deposit insurance to protect depositors. These measures aimed to prevent the kind of speculative excess and bank failures that had characterized the crash. The crash also transformed American political culture. The Republican Party's association with the economic disaster contributed to Democratic electoral dominance for the next several decades. The crisis discredited laissez-faire economic policies and created support for more active government intervention in the economy. Franklin D. Roosevelt's New Deal programs represented a fundamental shift in the relationship between government and the economy. Programs like Social Security, unemployment insurance, and federal job creation established the principle that government had responsibility for economic stability and citizen welfare. The 1929 crash provides enduring lessons about market psychology, financial regulation, and economic policy. It demonstrates how speculation can drive asset prices far above fundamental values and how interconnected financial systems can amplify relatively small problems into major crises. The crash also illustrates the importance of consumer confidence in modern economies. When trust in financial institutions and market stability disappears, the resulting economic contraction can be severe and long-lasting, requiring aggressive policy responses to restore growth. Modern financial markets incorporate many lessons learned from 1929. Circuit breakers halt trading during extreme price movements, margin requirements are more stringent, and regulatory oversight is more comprehensive. However, subsequent crises have shown that these protections, while helpful, cannot eliminate all risks. The 1929 crash remains relevant for understanding contemporary financial markets. The boom and bust cycles that characterize modern capitalism continue to create similar patterns of speculation, overconfidence, and eventual correction, though regulatory improvements have generally made these episodes less severe. The stock market crash of 1929 stands as a watershed moment in American economic history, ending the optimistic prosperity of the 1920s and ushering in the Great Depression. Its lessons about speculation, regulation, and government responsibility continue to influence economic policy and financial oversight today. Thank you for joining us for this exploration of the 1929 stock market crash. Tomorrow, we'll be back with our military history episode examining the Battle of Britain and its crucial role in preventing Nazi invasion of the United Kingdom. If you enjoyed this journey through history, please like this video, subscribe to our channel, and hit the notification bell. What parallels do you see between the 1929 crash and modern financial crises? Let us know in the comments below. Until next time, I'm your guide for History Explained, where we believe that understanding yesterday is the key to navigating tomorrow.